All right, back in the studio. Dustin TenBroeck here, CFP, President of Presidio Capital Management. You are on the Presidio Perspective. With me today, the notorious Jeff Anderson, CFA, Chief Investment Officer. And we are just ready to get it started with a good show. So, sorry, Sierra, but it's time to buzz the tower. Let's get it going. Oh, that's my jam. Thanks. All right. All right. Little Top Gun reference there. Big opening weekend. You know, some of us here at Presidio got an early viewing of that, of the new Maverick. So maybe we'll have to weave that into our theme today. So, Jeff, good to see you, man.
You too.
I feel like I'm looking at a new face. I haven't seen that before.
It's my summer beardless face. Nobody recognizes me.
Your shorn face. I feel like, you know, as a kid when your dad shaves your beard and you're like, who the heck is this guy?
You look better with the beard.
Yeah. So I feel like I'm meeting you for the first time, man. So it's not like me. I got to keep this covered up. As you say, I have a face for radio. So, you know, I say on this podcast, we look the best on Spotify. That's where you're going to get a best viewing pleasure, right? Anyway, we, at the end of last show, were saying, or I was saying, I was looking forward to a day where the markets were green and things were up and, you know, we weren't having one of those days and we got it. And so, you know, we have a lot to talk about today, but hey, you know, it's a little bit better than it was a couple weeks ago.
Yeah, it sure was. Or sure is, yeah.
Yeah.
So it's about time.
Yeah, we finished May, actually, the bleeding stopped for a month. So we finished, you know, a little positive, basically break even on the S&P. So what it was up about 6.6% for the month of May. Or last week,
which got us into the positive.
You're right, last week, which got us into the positive and just took that 12-month return just into the positive too. Basically flat though. So,
right.
But you know, what is this? Bear market rally? Kind of seems like that's the name of the day. You know, how long is this going to last? I mean, investors are asking that. Last time we were saying, how long is it going to keep going down for? You know, we're ready for a little relief. Well, we got it. And now I think a lot of people are saying, well, how long is this going to last for? I know we're going back down.
Right.
But pretty hard. You know, our crystal ball is broken, as we always like to say. So we're here for the ride, the proverbial roller coaster.
Yeah, it sure is.
But so I think today what we're going to talk about is what's going on in your portfolio. You know, there's a lot of lessons that I think people learned in 2021, and there's different lessons, especially new investors, that they're learning here in 2022. Painful lessons, which is usually the best opportunity for growth and getting better. So if they're newer investors, you know, they could be losing a lot of money and gaining a lot of knowledge. But we want to talk about what goes into a portfolio and why you don't have all your eggs in one basket, essentially. So I kind of want to talk through the different types of investing, what's worked, what was working, what's not working, and why, and like how can we invest to, you know, kind of insulate ourselves from that.
Right. Great. It's a nice divergence from talking about the economy for the last few podcasts.
Yeah.
I think this is a bit more pertinent.
Well, you know, there was a great concentration. So let's take through the difference between a growth investment versus a value investment. Okay, and so what do we notice between the two? Can you kind of frame up what are the differences in those types of investments?
Well, I think one of the
So a stock, like a growth stock versus a value stock, a growth fund versus a value fund. You know, what are we looking at different?
Right. So we just talk about growth stocks because it's something that everybody's been focused on for the last 10, 12 years. And if you go to Morningstar, they'll give you a precise breakdown on how they calculate the difference between the two. But basically,
I got it in front of me if you want to know, but
well, that's great.
Keep going.
Well, so
fact checking you, Jeff.
Right. So
Jeff, explain the calculation from Morningstar and growth versus. No, sorry. Go ahead.
Well, I could give you the 5 categories, but we don't have to get into that too much. But what's a growth stock? Well, growth stocks are, let's just take like tech, for example, would be a sector that would be kind of full of growth stocks. And they are stocks that are sales are growing higher than GDP, higher than basically the other companies or the other sectors within the market.
Mm-hmm.
And so they're kind of, to put in that growth bucket, it is sales growth, it is earnings growth, it is a lot less tangible stuff than, say, value. Value would be priced on like price to sales, price to book, price to cash flow, thinking of financials, thinking of industrials, thinking of even energy names. Those are the kinds of companies you would see in a value fund, right?
Mm-hmm.
And in a growth fund, you would see more along the lines of tech and communication services, like Apple and Netflix are communication services companies. So these are companies that are growing quickly. They don't have a lot of tangible assets usually, and they're usually more expensive.
Mm-hmm.
And value companies are kind of more stable, boring. And value companies tend to do better in rising rate environments than growth.
So over the last 15 years or so, so you have a chart that you shared with me. You want to let's pull that up. So this is the growth versus value ETF prices. This is going back to, looks like 2009.
Yeah, just basically the bottom.
Okay. And so what do we notice here?
We see a massive outperformance of growth over that 12-year period.
So this is price, right? So
13.
This is exclusive of dividends?
Right.
Okay, so
I could probably put up another chart that has total return as well, but
that's okay. If I look at this and I look at if I had $1 million in this value index fund, essentially by the end of 2021, I would have about $1.5 million.
Right.
If I'd put that $1 million in a growth fund, I would have had, it looks like, around 3.2 million, or more, double,
right,
essentially. But then we see what's happened this year, and there's been a big flip, right? And so all of a sudden, what was working very well, right, all of a sudden is not. So in 2021, the S&P growth category returned 32% versus 24.86 for value. However, year to date, value's up or value's down 2 and growth's down 20. That's a pretty big divergence.
That's a pretty big divergence. When we talk about, you said that $1 million grown to 3.
Mm-hmm.
When you look at the chart and it's given up, it's given up $500,000. That million, it's more like 2.5, right?
Yeah.
We've had a real, call it mean reversion.
Well, and so I mean, this is just like, it's not the first time, right? We saw this back, same exact thing happened in the 90s and early 2000s. In 08, growth got crushed a lot more than value. So actually value held up a lot better there. In those early 2000s, it was pretty challenging. Value was really winning the day in the 2000s, right?
Yeah.
But coming out of the 90s, you had a lot of growth and advent of the internet. We're projecting earnings 15, 20 years out, and tech wreck, 9/11, all that. So we're going through our own tech wreck right now. And so we're seeing this playbook play out. So a lot of investors, we forget these lessons of the past of why do we have asset allocation? Why do I have my money in different buckets, right? Why do I have my money in different kind of asset classes that aren't going to all perform the same? And during 2021, where large cap growth specifically was working very, very well, and so were a lot of things, but let's just say that was working very well coming out of the pandemic. And it just kind of seems like everybody was just chasing those returns. And that when I talk to investors, like new clients that are coming on board, and I ask them about their investment process, and actually this is the same thing for the last 20 years. When you ask people about how do they choose their investments, oftentimes it's, well, I look at what's working and I get out of the stuff that's not working and I put in the stuff that is working. So, you sell low and you buy high, right? And so, I mean, that's just kind of what was happening. And so here we've seen this big correction, which, in a diversified portfolio, you're okay. But I mean, if you really concentrated all your wealth into what was working really well, like you kind of get banged up and you have nowhere to go. Well, maybe you do have some places to go, and I want to talk to you about that. It's interesting too, you just said, tech growth or tech is full of growth, and I'd like, well, switch that. If if you look at the growth sector, it's full of tech. And so here's another kind of outperformance. If you look at the information technology sector compared to the S&P returns, over the last 3 years, tech up 115, S&P up 48. Over the last year, this is ending this of 2020. Tech up 43, S&P up 18. 5 years, tech up 240, S&P doubled. I mean, it's astounding, right? The differences between that and where information technology and growth is full of this information technology.
Right.
In fact, if you look at these, the growth index, right, that Russell 1000 growth index, you look at under the hood of what's in there, 46% of it is information technology.
Yep.
And so 46% is of this, great sector, but that's having some pressure. It's selling off. What's not considered that, too? You said it before, communication services. So Google, Meta.
Yeah.
That's not technology.
No. People think of it as
Of
technology,
course.
but it technically isn't.
And it is, right? It really is. But it's like, and you know what else is not there? Amazon and Tesla.
Right.
And we think of that as technology, but no, that's consumer discretionary.
Right.
So when you add up those four plus the 46, and that's actually in information technology, that's 64%, right? And so all of those are very similar. And so when the reason we bring this up is just because when you're putting together a portfolio, you want to stress test that portfolio to know what happens in a market sell-off, right? Inflation, taxes, market crashes. We talk about it all the time. These are the juggernauts. You have to be prepared. How do people prepare? They pretend like they're never going to happen. But here we are. So this is a real important part of having that diversification and asset allocation of portfolio, so you can weather the storm through markets like these.
Right. So it's a combination of, well, I think we're going to get to it, but the different kinds of growth, core, and value, but also large cap, mid cap, small cap, because they also have different return and risk profiles, right? Which kind of feeds into that whole idea of a diversified portfolio. So it's a combination. All of them, they all have these returns that are equity-like, but they all kind of move a little bit differently, and then together they're going to provide a diversified portfolio. But again, you can be in large cap and mid cap and small cap, but if you're all growth, you're in the wrong area.
Yeah, and in the small cap, it's been a little bit different. In the small cap, pure value has outperformed pure growth for the last 10 years. Growth nudges over the last 15, but over the last year to date, 1 year, 3 year, 5 year, 10 year, small cap pure value has outperformed small cap pure growth pretty significantly.
Right.
So it matters of where you are in the market capitalization, right? So there's growth and there's value, but we're just seeing a big concentration in that top right corner of the style box, large cap growth. And all of these other asset classes and companies have been neglected, which creates opportunity.
Another interesting thing about that you talked about small cap and value outperforming growth and being the opposite with large cap. An interesting thing too, when you're looking at funds, I think one of the things that we do, and the average investor would stand to kind of benefit, was you're looking at also, call it style drift, and size drift too, and that's another big thing. Small caps used to be market capitalizations between $500 million and $4 billion. And then mid cap was 4 to 10, and then over 10 was large cap. If you were to look at most mid cap and small cap portfolios, they don't look like that anymore. A small cap portfolio probably has a $5 or $6 billion median market cap. Many of them, and the mid cap portfolios will be well above 10. So you can have less exposure in small or mid when you think you have more. You have to kind of look under the hood and see what they're actually investing in, and sometimes they drift, and you have to keep an eye on that, because just by looking at the name, you might think you're diversified, but looking under the hood, you realize it's not always the same.
Yeah, those kinds of measurements always bewildered me, as you could put a dollar amount to what a small cap or mid cap is, because money changes value. Obviously, it's going to change over time. It should just be the percentage of where you are in the total market cap, right?
I think we're going to get to that time where those things are going to move up.
Yeah, well, they have. They just, that's why you got to call them a small cap, and they're not. Okay, And then, so let's say you have this chart, growth vastly outperforming, right, since the last big recession, the Great Recession. But you showed me this, which I thought were interesting. So where does this show me what we're looking at here?
This is the Russell 1000
Yeah.
this is before the dot-com crash. So this is taking back to the early 1990s.
Yep.
And then you'll see pockets of periods where value has outperformed and growth has outperformed.
Actually, I see most of the time value outperforming.
Right. But we got a little frothy in a couple periods. And you look here, I think it's interesting, right? In 1999, we had the tech crash.
Mm-hmm.
And it kind of been tracking value and then kind of outperformed and got ahead of itself and sold off. And then it kind of rotated into value. And then here we had, right around COVID, this run with growth and declining interest rates, lots of liquidity, kind of sexy tech names.
I mean, it really, after 2001, right, 2002, after the growth sell-off and a sell-off again during the Great Recession, it didn't catch until like 2019.
Right.
29 years. Which is something that I think investors need to pay attention to right now, right? And so what did you say about setting that anchor? Because this is what we want to look at, right? So let's look at, what do you mean by setting an anchor, first of all? What's investor psychology?
You get to, say you own a portfolio and it gets a
stock.
A stock, and it has a correction. And it's run and it's outperformed and it hits a number. Mm-hmm. And then it comes down, mm-hmm. right? And then a lot of investors get to that point where, well, I don't want to sell now because it was at $200 a share and now it's at $150, without really looking at the whole picture, which is maybe it's never going back to 200. We get into that mentality that, hey, I'm just wait till it gets back and then I'll sell it, then I'll diversify.
I mean, right now people are, sick to their stomachs with the anchors they've continually reset, I'm sure. Right? I mean, because a lot of those, growth names are down 65, 70%, some are more. I mean,
and many of those will never come back to that, call it that anchor.
Or 20, 30 years from now.
Right.
Right. And so I think a lot of times that investor psychology, and this is the first thing you learn in finance. Like when you study finance, your professor is going to teach you about a sunk cost. It's the first thing that you have to master when it comes to investing, that whatever happened in the past has no bearing on your decision in the future, right? Here, I own it today. I can buy, sell, hold, right? And I have to compare that to all my other options.
Right.
What happened in the past, setting some anchor of some price of the information you had back then. The market's changed because we have new information. That price is no longer real. This is the real price. Here's the new real target. And I think it's really hard for investors to move on. And when we say, when people talk about buying the dip, or hey, when the market's low, buy more, rebalance portfolios, sell high, buy low, we're talking about broad indices and asset classes. We're not talking about individual companies or investments. Because individual companies will go out of business. Individual companies will crater and never recover.
Right.
Massive, the most successful companies on the planet, you name them, are GE, GM. There's companies that have their heyday that you can't at the time ever imagine, Intel ever imagine, getting dethroned.
Right.
And they are, and they're never coming back.
Right.
So I think for investors looking at their portfolio, do you know what you own?
Just going to say that.
Right?
That is, we should be saying that every podcast.
So I don't think people do. I think a lot of people bought stuff because it was going up.
Right.
And they looked at things that were performing well, and it was FOMO. It was just fear of missing out and pie in the sky and just saying, oh my gosh. And it's hard when things are going up. It's that same thing. That sunk cost, I didn't buy at 50, it's now 100.
Right.
And then I didn't buy at 100, now it's at 120. And I didn't buy at 120, now it's 150. Okay, I buy.
Right.
Went up to 200, back down to 50. I mean, so many people did that. I mean, that was exactly what a lot of people experienced in the last couple of years. So, I think if we can have a process for selected investments that have a purpose, you understand what you own, why you want to own it, what your time horizon is, what is it doing for you. So does the price matter? It didn't. And it's kind of nice of this lesson where people are hopefully going to take these lessons that we've learned, although may be painful, and use them to be better investors for the next 10, 15, 20, 30 years of their investing life cycle. And we got this, this lesson that valuations do matter.
Yeah, it's anchoring is it's an emotional, it's a behavioral trait, right? And it's really, really important. But I think going back to know what you own is really important. So, when we're looking at a portfolio, constructing a portfolio of, let's just talk about equities and not fixed income, we are looking, and I think that Morningstar style box is a great way because everybody knows what that is. I think.
I don't think everybody knows.
Well, anybody who's read your article now in
there
in
you
Morningstar,
go. Plug for our Morningstar article. There you go. Thanks, Jeff.
But you've got 9 boxes, right? You've got large cap across the top, value, core, growth, and then the same thing for mid cap and small cap.
Yeah.
And it's nice to kind of put your portfolio in there and see where it falls. And then you can have an idea, and it's not that hard to see kind of which way the winds are blowing to tell you if your portfolio kind of matches up where the world is.
Yeah.
And some people might be really shocked to realize that they're more concentrated in one area than they thought they were. And again, talking about sunk costs, when you think about comparing it to something and forget about what happened in the prior, removes yourself emotionally from that stock. Mm-hmm. And I think that's obviously really important because when you become emotionally tied to something and it's not working in your favor, you go from a period of, we talked about it before, now I'm a long-term investor, and then it keeps going down, and then all of a sudden you kind of get confused, then you get angry, then you sell, and you have this reversion or this revulsion where you don't want to invest at all. Whereas if you have a plan, you'll be diversified, and we can talk about kind of where we see kind of the climate we're in right now with those 9 style boxes.
Yeah, and so I think that it's important to bifurcate individual stock investing versus asset class investing through ETFs and mutual funds and SMAs. Right. And so, one way is you have high conviction on an individual company. Most likely you're gambling because you didn't go and read all the financial reports. You're just kind of going with your gut and something that you like and something that maybe somebody told you got a tip, or you just think it's whatever. Right. How much work are people doing when they do their individual stock selection? It's probably what's working, right? Or companies that they see being game changers. We're all looking for those unicorns, the next Googles, Apples, Amazons, Teslas, that have had this phenomenal growth, shoulda, coulda, woulda 15 years ago, not going to miss it this time, which is great. And so when you say, hey, now I'm a long-term investor, and we should comment about that, but look, we're not saying throw the baby out with the bathwater here and just liquidate everything and lesson learned. But I think it's important, what are you investing to do? Are you investing in these themes, right, that we talk about on this podcast, AI and robotics and blockchain and human genome and settling on Mars, whatever, there's a lot of stuff out there, but the metaverse, right, and Web3. And so, are these are really long-term investments that are going to potentially take a long time to pay off, and should know that. And, this is, again, I want to be a long-term aggressive investor to maximize growth. This is the volatility that you get in pursuing that strategy.
That's what you signed up for. Yeah.
And Warren Buffett in an interview, years ago was saying, there's just some people that just should not invest in equities because they can't take the volatility. We obviously argue against that. We think that investors need education, and why we give so much education, because with the right education and counsel, you can, right? And that's what our job is, and that's why we have a job. But the reason is, he was saying why they shouldn't is because, to buy something at one price and then sell it because it goes down is just foolish. And just kind of, why would anybody do that?
Right.
Why would you sell your investment because it went down, right? You wouldn't. If you were in it for the right reasons and you knew what you were doing. if you only bought this thing because all you expected was for it to go up and it goes down, then you probably would. It doesn't fit what your goal was. Your goal was to only have an investment that just goes up, and that's not happening.
Right.
And so now we're going to look for that investment.
Right.
And tell us what that investment is. Jeff, please.
It's my secret.
Yeah. Doesn't exist.
It doesn't exist.
I want it safe. I want it liquid. I want it to grow. Can't have all three.
Right.
All right. So we're going to have a little bit of everything in the portfolio. So, okay. So it's not just growth companies. We have value. We have blend. We have companies that you can buy at a reasonable price, right? So we can look at how much cash flow a company generates. What are their earnings? What is their book value? How much are you paying for this, right? I think that cash flow is coming in pretty important for analysis these days, certainly for us in the way that we view our portfolio. But yeah, if you can generate how much cash a company can generate, and you're buying it at 6 times cash flow, it takes you 6 years to equal what you paid for it just on the cash that they generate on an annual basis. Right?
And when it's trading at 50 times,
yeah,
it's going to take you an investable lifetime.
Yeah, right. Or NA, not applicable. We
Right.
don't generate any. We're borrowing money and burning money. So, those are very different kind of categories. And, there's a place to have both in our portfolio. We want something winning. We want to be able to have something winning so we can rebalance, we can sell, we can, raise cash when we need it. That's part of the strategy. So growth value, large, mid, small, right? We have different categories, different types of companies that perform differently in different periods.
And then international, which
yeah.
we didn't really talk about, which all those buckets fit, but we just talked really about domestic. I mean, everything we're talking about applies internationally, but
No, let's talk about international because, international is something that hasn't worked, since about, tie it to growth. I mean, international is kind of like the new value since the last recession. It's kind of tracked the value investment, right?
Yeah.
Because it is a value investment.
Yeah.
Trade, you look at the multiples and it's, 10,
much cheaper.
10 or 12 versus 18 to 20 historically,
yeah,
right?
times
On
earnings. Yeah.
So it fits that value box.
Right. And investing everything moves in cycles, but they all have an average expected return, right? International returns aren't that far off from domestic returns. I don't have the numbers in front of me, but
Well, they're pretty far off.
they're far off in the last 10 years.
Yeah.
But what happened the 10 years before that?
Right.
From 2000 to 2010, international stocks, especially emerging stocks, emerging markets, did better.
Yeah.
And one of the reasons was the dollar. I mean, it's negatively correlated, meaning it moves the opposite way. A strong dollar is not good for emerging markets. Why? Because a lot of emerging markets countries raise money in U.S. dollars because they can get more and they can get better financing. The dollar goes up. What do they have to do? They have to pay it back with more expensive dollars. They have a lot of commodities attached to them, which just means they've got to spend more foreign currencies to buy that barrel of oil. And so during the period of 2000 to 2010, you basically had the U.S. dollar going down, emerging markets were going up. You reversed it, and then you had a 10-year pocket of underperformance where emerging markets and just international in general has underperformed. But just because that's happened for 10 years doesn't mean that's the new normal. They move in cycles.
People have been making a call, mainly, asset management companies, investment management companies, have been making a call on emerging markets. All the big 401k providers, all the mutual fund providers that we know, remember Vanguard putting out a piece 10 years ago, why international. And if you look at a lot of their target portfolios and target date portfolios, it's like 30-40% international, right? As their equity, right? There's this big equity international rating. Now, they'll, of course, charge more on all their international funds, but I'm sure that has nothing to do with it, right? But yeah, for the same reasons, right? There's why we want, value, and there's relative value there. So there's been this case, right, where they are, the PE is low, there's a reversion to the mean, it's going to come back, this is a great entry point, and it just hasn't worked for the last 10 years, although they've been saying it for 10 years. And so we look at, you're drawing the correlation to the value of the dollar, and draw those correlations to inflation. What I can kind of surmount is that international markets don't work when the U.S. market is working. It is the U.S. stock market is the preferred market to invest in globally. Yeah. I don't think there's any question.
No.
Globally, the preference is to invest in the U.S. But when sovereign funds, portfolio managers, pensions need to invest and have a return, and the U.S. market's not working, you get this massive flow of capital to international, developed, and especially emerging markets, where you have this opportunity, this new growth and value, right? Developed being value, emerging being growth. U.S. markets aren't working. So that's also the importance of having things like that in a portfolio, is like, hey, maybe it underperforms when U.S. markets are working, but historically what I can see is that they have a better chance of outperforming when the U.S. markets don't work. And not to say it's totally mutually exclusive. I mean, there's plenty of years, 2017, 2019, where they're raging together lockstep, but, and these kind of secular markets, that's what we saw. And what you were referencing in the 2000s.
Right.
Man, they're flying through our show here. We're at 30 minutes already. Well, okay. We'll talk about real estate, fixed income, crypto on another day.
Yeah, I didn't think we were going to get to it today. You were confident, I wasn't.
Yeah. Well, hey, you know what? Let's come back and tie it back into our Top Gun theme here. Because, during these markets, I like to say it's better to be Iceman than be Maverick.
Well said.
Okay. We don't need to be a Maverick right now.
No.
It's nice to be playing by the rules, understanding how to construct your portfolio, using math, using science, and not doing anything silly, as I always comment here. But, doing something silly and being dangerous, being Maverick, you can end up being Goose, right? And how do you be Goose? How do you die? You hit the eject button at the wrong time, and you hit your head on the... So did I take this analogy too far?
You really enjoyed that movie, didn't you?
I do, and I enjoy making analogies on this podcast, I think.
But that was good.
Yeah. So anyway, let's be Iceman. Let's stick through this market. It's nice to have the relief. Could be short-lived. It's okay. We're in it for the long run. But understand what you're investing in. Why do you own this thing? What is it doing for you? Is there a better opportunity to be investing somewhere else? What is your time horizon before I need to sell this investment? Is it at what's the downside from here? What's the upside from here? And what does that compare to the 1,000 other options that I have? So, we can help do that work for you. All right, Jeff. Good to see you. Are you going to grow out the beard for the next podcast?
I don't think so.
No?
No.
This is a summer look. I like it. All right. Sounds good.
You're Johnny Carson. I'm Ed McMahon. He always had a nice shaved beard or a shaved mustache face.
All right.
So I'll just be here for comic relief. And
there you go. You're hilarious. All right, everybody. Good to have you back. We look forward to having you on the next show here at the Presidio Perspective. Please check us out. You can subscribe to our YouTube channel, and you can always follow us wherever you listen to your podcast, Spotify, Apple, Google, Buzzsprout. PresidioCM.com has them all for you. You can go there and check out any of our YouTube podcasts and actually listen directly on the site. So thanks for joining us. Have a good one. We'll see you next time.
See you later.